All right, hello traders, hello everybody, and welcome to today's webinar. It is going to be a banger. You guys really want to hang tight to this. We're going to combine several sciences. You guys know that finance is not technically classified as a science. Well, we are going today use the likes of physics and what we can measure in physical wave patterns, and we're also going to be talking about mathematics. Now, today's webinar is all about oscillators. Here we have them on the screen. Guys, with your if you will allow me, I will keep the other things that I have on the graph, but I will add several oscillators, and actually we're going to do a spin just to randomly pick several oscillators, and I will give you tips and tricks and little hints on how you can improve your bottom line, understand the oscillator better, and just trade in general better. So today's webinar is going to be a mentorship session where I will help you guys to understand what oscillators are. So just for a quick question, or for a quick few seconds, I want to say hello to everybody in chat. Thank you guys so much for coming, and welcome to the webinar. Like I said, the information is going to be very quick, and it's going to be very helpful in your trading career. Now let's start with just the basic definition of what is an oscillator. An oscillator is a way of measuring something going back and forth. That's what an oscillation is. It's the movement of something back and forth from the beginning, from the start till the finish. Now, give me guys 1 sec. I want to see if I can find a picture for you guys in regarding to these oscillators. Perfect, guys. 1 sec. So the things that I wanted to show you today. The downloads. Wow, what did I call them? I can't believe I closed the document. Give me 1 more sec, guys. I just wanted to show you guys a picture of what an oscillation looks like in the mathematical sense. Here we go. So basically, this is what a wave frequency looks like, and that is very similar to what we have going in the market. As you guys can see, this initial market move is kind of what we have, you know, the wave-like tendency that the market moves. And oscillators help to measure just that. They're used in the most common uses in the planet, or in the world right now, are of course 3D, or excuse me, not 3D, but Wi-Fi. Those are waves that are measured and given out by using oscillators. And then we also have the processors in our computers and in our cell phones. They also work with the process of oscillating an electrical current. Electricity is an oscillation. Wi-Fi is an oscillation. As you guys can read in the description for the webinar, we have the ocean, human emotion. You know, all these things are wave structures. And that's why we use, out of math and out of electrical engineering, we take several oscillators and use them in trading to increase our understanding. There's 2 ways of using oscillators. The first one is to understand where price is going, but the second, more kind of sneaky way, or kind of unintuitive way of using it, is looking for divergences. For example, price is going in one direction. Let's go ahead and have a look at the euro dollar as the most traded financial asset in the world. So we have the euro actually is quite flat over the last year. I wanted to show you where we have the divergence, that we have price going in one direction, but the oscillator is showing us a different picture. Let's drop down to the 1-hour graph, and I'll show you guys some examples. So perfect. This is a perfect example of the NASDAQ making an attempt at a reversal. So have a look at this. We're in a bullish downtrend. Guys, go ahead and let me know in chat if this is, if I'm going too fast, or if I missed anything that you guys say you'd like me to get rid of some of the indicators that I have on my graph. An oscillator is an indicator. So gaming world, he's asking, are indicators and oscillators the same thing? when you click the indicators button right here, it actually gives you all of the indicators. And believe it or not, a drawing tool is also considered actually a drawing tool is a drawing tool. But yes, oscillators are indicators. But there's different kinds of indicators. As you can see here, there's a trend indicator, and that's the majority of them what I have here. So the zigzag that I have up here, come on. The two zigzag indicators that I have in green and yellow are trend indicators, along with the exponential moving averages, the three EMAs that I have here, 50, 100, and 200. And then the purple, actually the Bollinger Bands indicator, is another indicator that is not a mathematical oscillator per se, but it gives you an understanding of where we are in the market cycle. For example, if you have a look in the purple area that I have on the graph, this purple area is the Bollinger Bands indicator, and price moves no matter what kind of trend it's in, an uptrend or a downtrend. We have the indicator touching the bottom, then touching the top, then touching the bottom, then not touching the top, and reversing again bottom to top. This is the one thing that I want to get across to you guys, that there is no perfect indicator. There is no 100% reliable oscillator or indicator that you can use. That's why I have partially so many on my screen, is because each little piece gives me a piece of the puzzle. And I agree that right now there may be a bit too much on the graph. I am practicing using Elliott wave theory to understand wave patterns a little bit better, and that's the zigzag 10 and zigzag 30. The green and yellow that I have help me to understand where we are in the kind of three-step Elliott wave theory market analysis. All right, let's go on to talk about where you can steal from different sciences little tips and tricks to help you in trading. So for example, different sciences can be applied if you know some sort of correlation between physics and mathematics, but those are the two sciences that we can use to help ourselves. So for example, in mathematics, you can use, and obviously it is quite often applied, to the sphere of finance, and there are formulas for simplification and efficient wave theory that applications can be used. And you can, if you know mathematics well enough and you have certain theories where where wave theories can be applied, you can take some of that knowledge and use it in trading. Same thing for physics, for example. If you have a deep understanding of certain laws of nature or certain laws of physics, you can find a way to apply them in your trading. I'll give you guys one example. Imagine you fell out of a 3-story building, so something like this in the market, right? You have a big fall, you fall out of a 3-story window. How long is it going to take you to get up? Are you going to get up right away and run up to the 3rd floor again? Are you going to, from this crash, come back up to the top of the floor that you fell down from? Not likely. You're probably going to get up, dust yourself, and that's a very crude example that I'm giving you guys, but you can use it in trading to understand that after a huge fall, after a fall where some stop losses were taken out and some bones were broken, if you want to think about it that way, the price is not likely to reverse back in the same day or in the same 1-2 days. So this is important especially when you guys are trading FTT and you're expecting that, okay, we fell down, and you either have to catch it at a really good moment and then have the trade finish really quickly, or you have to understand that maybe wait for a continuation, wait for price to recover a little bit before you plan a trade, before you place a trade without it picking a specific direction that it's going to go next. So in trading specifically, we use oscillators as a form of chart analysis. It's a way of looking and comparing price levels, because the swing that we have back and forth usually starts or usually happens. It's the way that the markets move. They move in waves. They move in back and forth movements. And so all oscillators, we have the CCI and MACD, which are oscillators. They all usually measure something from 0 to 100 or 30 to 70. So the most popular one would be the RSI. Where is it? Here it is. That is the most popular oscillator. Then we have the likes of MACD is very popular. It gives us actually some different clues than what most oscillators do. And then we have, say, the Aroon oscillator, or let's say stochastic, just to show you guys what different oscillators show us. So right now we're going to be, let me change the asset to something else. Let's leave it at the Euro stocks. There we go. So two things that we can see from what an oscillator tells us. Let me go ahead and leave one on so I don't confuse you guys, and then we'll have a look at all of them. So two things you can see from the indicator. A, you can see where we have oversold or overbought areas. So right here, this would be overbought. This would be slightly oversold, but this would be a better example of being oversold. And this area is overbought. So one thing that you can choose to do is sell from areas of where price is overheated, or buy from areas where the pessimism has taken over. Now the stochastic oscillator, it shows the signal where we have a cross right here of the moving averages. Actually, the cross started in this whole entire area, but then the cross is confirmed with a move down. And notice as the move down happened, that would have been the best time to sell. And vice versa here, during this area is where you should pay attention, right? That it could be time to trade really soon. And then when the actual move up happens right here, it would have been, would it have made you quite rich? No. And that's what you need to understand, that the oscillators, you need to use them in conjunction with fundamental analysis, like what's going on in the world and what the global trend is. Again, we are on the hourly graph, and so it's always wise to do the analysis on the daily graph, because there you know what is going on, what is happening. And a signal from an oscillator, the stochastics oscillator, on the daily graph is much more powerful, is much more reliable than what you would get on the hourly graph. The hourly graph is much more reliable than signals you would get on the 10-minute graph. And the 10-minute graph gives us much more reliable signals than what you would get on the 1-minute graph. Understand that the shorter your time frame, the less reliable the signals are from any kind of indicator. All right? And so start your analysis with the daily graph, and when you see an actual move happening, when you actually have one of these trade signals, that would be the best asset to trade at the time, where we have an actual signal from maybe several indicators that tell you to buy or sell. Then you go ahead and drop down to the hourly graph and plan your trades from there. This, in my experience, has been the optimal kind of market move. Now, I'm not going to be showing you guys and going into detail with some of the trades that I took, but I was watching Non-Farm last week, and Non-Farm remembers not only the United States, but the Canadian economy reports on unemployment data as well. And so I caught some really good trades that boosted my account by about 50%, about 33% in the course of a week. This was actually over the weekend. So I'm trying to share with you guys some of the approaches that I use that have worked for me over the last 10 years. So moving on, what kind of oscillators are there for us? Actually, before we get there, I wanted to once again talk about divergence. Very, very important, divergence or convergence. Notice here that we are in a local, remember this is a local downtrend because the global trend is an uptrend. But look at this spike. We're making lows. This low went lower than this one. This one pushed even lower, and we're trading below the 50 EMA. So to us, this could be a change of trend. We're looking to sell, and we go ahead and drop down to the hourly graph. And this is where we have convergence. Look at this. This high, and then this high. Confirmation on the oscillator, check. This is a check mark that we are doing and the oscillators is confirming that price is going down. Same thing right here, this low and then this low. You can barely tell because the measurement unfortunately is not as precise as on the graph, but you can tell that this low is slightly lower than this low, and we have the desire of the blue moving average, which is the faster moving average. We have the desire to go lower. And this is a confirmation that anytime this price shows us a desire to turn lower, a desire to go bearish, and what would be a good signal right here, guys? What would be a good signal to trade? Well, a big engulfing candle like this. If we have a big red candle that swallows the entire move, that would be our indication. Let's look at some of the turnarounds that have happened. So this would be a correction, excuse me, I guess a retest of higher levels, and then this big red candle shows us and gives us that signal that we should sell. It can be something very subtle, like an engulfing candle like this or like this, but that's precisely what we're looking for. Now, keep in mind that if you do take a trade like this, again, this is the Euro stock, so this isn't a free moving market instrument like, say, a currency pair would be. This index is dictated by what 50 other stocks are doing. So it doesn't have that kind of natural feel to it as you would find in a currency or in the price of gold or in the price of Bitcoin. So again, this is an instrument representing a basket of other instruments. So the movements are a little bit different, and you have to kind of get used to that when working with different markets, with different financial instruments. But usually when you're trading currencies, a red candle like this would signify that yes, the trade has, it's time to make that trade. So for those of you guys, we have Europe in the middle of their working day right now. So there could be a change of trend, absolutely. Remember, the United States traders, the US colleagues, are going to be coming online in about an hour from now, and they will move the European markets, they will move the US markets, so definitely something to keep in mind. So convergence, divergence, excuse me, is another way of using oscillators. Very powerful way, and that's why I have two oscillators on my graph. My personal trading, I use the MACD and CCI. So I showed you guys some examples right there. Remember that human emotion drives these market moves, and so when we have, say, in the case of divergence, it just indicates that the price change was not happening as quickly as it was when the move started, and perhaps market participants are shifting their opinion or not as, I guess, as aggressive in pushing their trades forward. Remember that it's always other trades that are moving the markets. They don't just kind of randomly move by themselves. It's people, millions of people actively opening and closing trades, putting in bids for different orders. And so that's what we are working with. Let me go ahead and see if you guys have any questions, and I will go into detail about several market, several oscillators, and and we'll see what we have for you guys in terms of all right. So I'll also have a game for you guys on the oscillators that we have. So let's go ahead and quickly create a list. we have Eric as the winner. I'm typing in the the oscillators that we have. If you guys have an indicator that you would like me to look at and tell you different ways of using it, go ahead and write in the chat right now. I'm going to be picking a few of them and letting you guys know what would be the best. What would be the best opportunity. So here we go. Let's go ahead and pick one, I guess, out of these indicators that we have on the platform, and I will see if you guys have any questions yourselves. Please let me know from where I can learn about oscillators, their meaning, their use, etc. Actually, Gaming World, that was, so MACD, perfect actually. It's one of my favorite oscillators and has a lot of information that it gives us. So you can Google anything about, like, if you're looking for electrical currencies or measuring other kinds of waves, radio waves, you can find all sorts of information on YouTube. If you're looking for specific market oscillations and you're looking for how indicators work, that would be our channel. We have a large library, a whole playlist of explanations about the different indicators, where they came from, who created them, how they were used, their history, and of course recommendations for the parameters, because each oscillator has their own parameters, guys. Have a look. So this is the MACD line. This is 12 and 26. That would be the green wave, and then the red wave is 26. We have the signal line, or excuse me, the signal line is 9. This is the measurement of two moving averages, and the difference between them is the green line. And then we have the 9 period as the longer one, and then the histogram, which is very important, guys. Whenever you use the MACD, I recommend to move the histogram all the way to the end, as it is an indicator in and of itself. All right, guys, I want to remind you that sharing personal information is usually not a good idea, and I'm sure YouTube has some sort of system against that. I'm not going to be banning or blocking any of you guys at all, but I will remind you that please don't share your personal information. So the MACD, guys, we're coming close to the end of the webinar. Go ahead and write any kind of indicator you want to have a look at, but we are looking at the MACD. So first things first, one signal, guys, write this down. If you want to be trading using the MACD, write these things down. One preliminary signal that you have when using the MACD to trade, and let me go ahead and choose a different one. So I had somebody talk about Brent. I want to show you that oscillators, that technical oscillators, are very powerful when used on the commodities market, as the commodities are very wave-like and very cyclical. So one trade signal that we have is when the moving averages leave the histogram. Now maybe this is not the best example, as the leaves here are pretty chaotic, but if we drop down to the one-day graph, then you have some sort of stability. Now this trade signal comes from leaving the histogram. So whenever price breaks out of the histogram, so right here the orange line broke out, and on this candle right here, the very next candle after the breakout, come on, would be a buy, and that's exactly the buy signal that we're looking from. So what I'm looking for is the orange line to break out right here. These two candles, this difference, break out of the histogram. Now the reverse, the sell signal, would be the same thing right here. So a sell signal right here, but price is moving up. And that's why it's important to not only look at one indicator. Looking only at the one histogram is probably not a good idea. You want to have some other clues as to what's happening and what we can expect from the market. Again, my moving averages, where we have the price action trading quite significantly above the 21 moving average, the 50, the 100, the 200, is usually an indication that we are in an uptrend. So having a moving average, here I have 4 of them, but having a moving average on your graph gives you so much more understanding of where the market is and what the market is likely to do next. If we're trading below the moving average, then yes, looking for a sell, like say at this breakout right here, would be normal, but we had a different signal, and we had a buy signal. So excuse me, the sell signal would have been somewhere around here, but as you can see, the MACD histogram is very tightly coiled. If the histogram is very tight, then we're in a range, and that is when most traders get just butchered. It's super difficult to make money in a move like this. So when you're looking at the graph and you have something like this, guys, have a look at this area. This is crazy difficult to make money on. Crazy difficult. It doesn't matter if you're trading FTT or Forex, it's crazy difficult. So you're always looking for good structured market movement, although this is kind of flat itself. And again, you don't have to swing at every pitch. You choose which asset you trade. Trading is very powerful, that it gives you the option. You're not forced to take crappy trades. You're not forced to take trades that are difficult to understand, that are difficult to predict. It's actually your job to look for something very easy. It's your job to look for something very, very stable. So out of stable currencies, I would recommend definitely the British pound or the US dollar, Canadian dollar as a very stable cyclical currency. Guys, when you see something like this, and you zoom in a little bit closer, it gets quite difficult to use only the MACD, but like I said, we're in a downtrend, and when the orange moving average leaves the histogram right around this candle, good time to sell. So you know that you're in a downtrend, like even looking at, so this is after the coronavirus sell-off right here, guys, so it's super difficult markets, but then coming up to a market like this, and we have a nice correction right here, a breakout of the moving average is a good time to sell. Another signal from the MACD, guys, before we move on to another one, is a cross of the zero line. So here we have in the middle the zero line, which the histogram kind of moves around of. And whenever we have a cross into one direction from the other, that is a sell signal in that direction. It's a little bit late because notice how soon we get this signal that I gave you, and then when the cross comes. The cross is right here. So in a little bit of the chop, then we have the sell signal there. So that's kind of the second sell signal. And the third one, the third signal that the MACD gives us, besides convergence and divergence, and I'll give you a good example of that, is the cross of the moving averages. But as you can see, they kind of cross at exactly the same point that the histogram moves over the zero line. In fact, that's exactly when the histogram moves through the zero line, is during the cross. That's exactly mathematically where it's supposed to. I'm sorry, I should have told you guys that in the beginning. All right, so that's the basic function of any oscillator. Let's go ahead and pick one more if you guys haven't asked for anything in chat. So Ankit Sangha is recommending that CCI is best with inverse Bollinger Band. That absolutely could be. I actually have not used the inverse Bollinger Band myself, but here we have the likes of the Aroon indicator. Now this is a little bit of a different indicator from what we have from the other oscillators, but it also measures from 0 to 100. It actually measures the power, the pressure of bulls and bears, of buyers and sellers. And so the up line is a measure of how much people are buying. That's it. That's all it measures, is buying power, buying pressure, excuse me. The down line measures how much selling pressure there is. And so when we have the, and look again, we measure from 0 to 100. This bottom line is 0, this top line is 100. Then we have 30, 50, and 70 in the middles here. These are the levels that this measures. Whenever we have an asset cross above the zero line, it means that that power in the market is in control. So that means when we had this line go up, that means bulls were taking over. That means it was time for a correction. We're in a global downtrend. This is the US dollar, Canadian dollar currency pair. We're in a global downtrend. But after these guys rise, that means we're in a correction and bulls are in control. Same thing here. Bulls rise. Now when they fall, when the blue line falls, that means there's no buying pressure. That means people are not buying. They're opening and closing sell trades, but they're not buying. And so same thing for the bearish line. Whenever the bearish line, the down line is up above 50, that means sellers are in control. There's constantly size in the markets to sell, selling pressure. And how you can read this indicator, there's again a few things that it gives us. It gives us when we should open a sell trade. So right around this level, when we cross the 50 line with the down line, that means it's a good time to buy. Another time to buy, just a little bit, it comes a little bit before that, is when we have a cross. So have a look right here, a cross of selling pressure down down into buying pressure. Actually, this isn't the right signal. this would actually be a buy signal. If we're in a global uptrend, a cross of the up over the down would give you a buy signal. Let me see if I can show you an example of that. Say the S&P 500. Here we go. So this would be where we want to buy. Selling pressure is going down, and then we have buying pressure increasing. So this would be a good buy signal that you can take for an uptrending market. All right, so you guys, that's coming to the end of today's webinar. I hope you guys learned something new. Go ahead and leave a like if you enjoyed the comment or content, and if you guys have any suggestions, if there's any questions that I didn't answer today, we're trying to keep these webinars around half an hour so that it's not too long for people to watch. But if you have a question and it is left unanswered, go ahead and leave it in the comments section after the video is published. Remember, it's a recording, so you can come back to it and watch it at your own leisure. And if you have any comments, questions, or suggestions, go ahead and leave it in the comment section below. My name is Yaroslav, and together with Olymp Trade, we wish you guys good luck trading out there, and see you all next time. Peace.